How do the income statement and balance sheet connect and interact? Which financial statement is more important, the balance sheet or the income statement? The answer is both. They each have their own focus and purpose. This video provides you a deep understanding in less than 5 minutes. The balance sheet is an overview of a company, assets and liabilities at a point in time, usually the end of a quarter or the end of a year. A balance sheet shows you what a company owns and when a company owes. As the term balance sheet suggests, the total assets should match the total liabilities. What we want equals what we want. A balance sheet shows you where you got the capital for the company on the right and what you have interested in on the left. The income statement or profit and loss statement is an overview of how much a company has earned during a period. Some companies use the terms revenue, expenses, and profit. Others use sales, cost, and earnings or income. If your revenue is bigger than your expense, you make a profit. If expenses are bigger than revenue, you make a loss. The way to remember this easily is to think of the balance sheet as a picture at a point, and the income statement as a movie about a certain period. Let's put the balance sheet and income statement side by side, starting with a bank sheet. We will make some journal entries to show the relationships between balance sheet and income statement. If you start a company, we need to raise capital. The certificates of ownership that we give to shareholders are called equity, and they send us cash. Our company now owns a balance and owes equity to the shareholders. Then we might apply for a loan from the bank. When they sign the loan agreement, we are in debt to the bank. In return, we receive cash. With the money we raised, we buy plant and equipment, in short P&A or fixed assets, a building and some machines. We now own the plant and equipment, and in return for getting the keys to the building and the keys for a forklift truck or cash reduced, we order inventory for supplier. The delivery trucks brings you the inventory and other assets, something you now own, and you receive an invoice from your supplier that you have not paid yet. So far, we have only touched the balance sheet, growing both with what we own and we owe. Let's record some costs or expenses. We receive an insurance charge related to the bank loan and pay in the cash. We account for the usage of a plant and equipment through a depreciation entry. We record salaries for the staff in our shop and pay them in cash. Then we finally make our first sale. Note that this took a while after starting the company. For the sales transaction, we record the invoicing of our revenue and the claim of future cash from a customer. We also record the shipment of goods of the customers and the related short cost of sales. Then we can calculate subtotals: gross profit, operating profit, profit before tax. We record the tax charge of 20% of the EBT paid in the cash. And then to finish of the income statement, we calculate net income. Now we seem to have a problem. Our balance sheet does not balance. Our assets are bigger than our liabilities. What are we missing? This is, we need to remember that the balance sheet is a picture at a point in time, and the income statement is a movie about a certain period. We need to somehow connect the picture and the movie. To do that, we add the net income earned during the year in the balance sheet of the end of the year. Interest is the reward for the bank for granting us a loan. Net income is the reward for shareholders for making risk-bearing capital available. We add the net income earned during the year to equity in a sub-account called retained earnings, and the balance sheet is balanced. That's how the balance sheet and income statement fit together. Thanks.